Hello, everybody. This is John Blank, Chief Equity Strategist and Economist at Zacks Investment Research. I am here on a Monday, May the 9th, to talk about a subject that will be of interest to all of you. Before we go on from here, I'd like you to read this disclosure. The views of myself, John Blank, are not necessarily the views of Zacks Investment Research. Past performance is no guarantee of future results. And you can go ahead and read the rest of this yourself. Important to understand this. This is just my view, and I'm giving it today on behalf of my company. So what we're talking about today is the global story of consumer price inflation. And I'm going to focus, again, on valuing volatile energy firms. And at this day, I'm going to do oil and gas and alternates as well. Now, if you look back at the prior discussion we had a couple of weeks ago, it was just solely on major oil and gas companies. I'm going to take that in a little wider span today and do another deeper dive. So I want to tie it, though, today to the story of global consumer price inflation, which obviously influences and it is in the news a lot. This Wednesday, we'll get the CPI reading, and people are very concerned about this. And basically, it is being led by the oil and gas prices. So we need to talk about this. So I will have two parts today. Part one, a global look at the consumer price inflation story. And part two will be top oil and gas companies and top alternative energy companies. All right, part one, a global look at the consumer price inflation story. What broad conditions should traders and investors be made aware of? My first chart, headline and core consumer price inflation indices and the main components over the last 25 years. Okay, the volatile food and energy components, which we're going to focus on today, are in that first frame. So I'll go through them. They're up here. CPI energy, CPI beverage, CPI housing, which is the maroon lines stuck at the top in a very smooth fashion. And then we get down here, CPI core and CPI transportation. So the ones that I am focusing on is basically today will be that orange line, CPI energy. CPI energy, as you can see, is generally spiking in '08, and that was part of the '08 recession, which is why we have a lot of concern now. Because as you can see, when that orange line breaks the other horizon of these more stable sub-indices, that does indicate some concern. However, I will point out to you, 05, 06, it did it, and 11 and 12, it did it. So, and frankly, it went out to 14. So, while oil prices have also a record of being above that template on periods of time that are not recessionary and can go on for 3 or 4 years. So, in other words, there's a lot of stories that are tied to the price of oil and gas. And that first chart kind of lays it out. Down here, we've got all kinds of different ones that are much more standard stuff that people buy: apparel, commodities, durables, education, electricity, non-durables, and recreation. And again, all you can see here is that they basically go along fairly much to the sideways, and they start their ascent somewhere in the shutdown period, which you see is this box or gray period at the end and extending into the present. This last thing should not be considered a recession. It is only just a period referencing the current moment of the COVID period. But you can see really all these lines have started their slope upward. That is of concern to all of us. The bottom one is the medical stuff. We won't talk about a lot about that today, but as you can see, in a regulated space, these types of prices tend to move in a more regular fashion, very systematically into the insurance companies, and then out to you and me. So you can see that when people talk about markets, they're actually very different ones. There's the food, beverage, energy, transportation market, which is much more volatile. There's the urban apparel, commodities, and durables market, which is less volatile, but still volatile. And then there's the healthcare market, which is not volatile at all. All right, let's go on. Okay, headline price indices, headline and core over the last 25 years. Again, I'm putting this time, the energy line goes from orange to blue. You can see that light blue line. And again, you can see it breaking that crest of the beverage line and the housing line in the places that we talked about. However, this time we're going to put the transportation line closely aligned with that blue line. So that is your car line. And as you can see, we all learned about the problems of buying and using new and used cars right now is going up with the price of gas. There's another thing that's very concerning. So beneath that is the all items CPI and the all items less food and energy. So less food and energy in general is supposed to be less volatile. That's why we separate it. So take a look at this chart and see if you can see that the light blue line is less volatile than the dark black line. And here is where I'm pointing out that in truth, the food and energy component is actually fairly stable, other than these periods of volatility, which is, by the way, what we're in right now. So people really should be concerned and are concerned that these are introducing volatility into price indices and into our lives right now. And yes, they are often tied to periods of poor economic performance. So down here, keep this chart in mind as well. This is the components, the weighting of the overall CPI from the sub indices. For example, food and beverage is 14% of the story. Housing, whether rental or owner occupied, is 42% of the story. Apparel, we've broken it out, but it's not a very big story, 2.5%. Transportation is 18%. Medical care, 8%. Recreation, 5%. Education, 6%. And other goods, 2.7%. So again, keep these weightings in mind when you look at the overall CPI versus these components as we get a little further into this and switch our focus to the story of consumer price change for global economies from 1960 to now. Now, one thing we need to understand, and has not been as diligently produced in the media today, is that the consumer price inflation the United States is experiencing, whether with oil and food and energy or not, is consistent with what's going around the world, other than in Japan. Japan is the outlier. It is this dark blue line. And then, as you can see, Japan is always beneath all of these other economies, unless you go back to that 1973 period with the oil embargo, when in fact they were in worse shape. Otherwise, they truly are the outlier. That's why the BOJ, the Bank of Japan, is able to keep its rates lower than everyone else. It's also because of that difference between their rate structure and the higher rates around the world, why the Japanese yen is depreciating so much. It's playing the role of the central bank, tightening for Japan, even though it's not, delegated that the exchange markets will do that for you. And so here we have a story of how long the last energy consumer price inflation story actually lasted. Well, it started in the early 70s, you can see, and it actually hit everyone fairly consistently, whether it was Germany, Canada, France, USA, or Japan. They all saw it and started at the same time. It needs to be pointed out it actually lasted for a decade. So this is concerning as well. The last time we had an energy shock, it did not go away quickly. It went on for a decade. Do I think this time is different than that time? Of course it's different. How different and in what way it's different would be a very detailed discussion. But the truth is that you actually do need to have some probability of a very long period of time with high energy prices in mind. It's entirely possible, but I will also point out that energy is 7% of the CPI. So in fact, we can endure a long period of higher energy prices and actually do fairly well with lowering your CPI on other components, if in fact we do that. Also, I would point out nowadays we have a lot of electric vehicles. Anything that shows this type of spikiness will only produce a more rapid change to electric vehicle use and production at this point in time. So there will actually be a boom in electric vehicles that will be stimulated this time around. That's different than that last time. Now below here is a different set of countries. China and India is in there, Korea is in there, Great Britain's in there. And what I want to show you here is that when you add in India and China, they had periods when they were much differently managed as an economy through the 70s, 80s, and 90s. You can see that there was a huge amount of volatility in their inflation rates, and they did often go up 15, 20, 25%. So the other history you need to understand is that there was relatively recently, all the way up into the 90s for China and India, very spiky inflation problems. And it's only been in the last 20 years, really, that these countries have tamped that down. And of course, now they are experiencing, just like everybody else, higher inflation, but certainly not to the degree the rest of the world is, for the same reason that the CPI health doesn't move around much. They're much more managed economies. They put pressure on these prices. And so the prices that are reflected in these charts are from the government, and they simply don't let them move. All right. So headline is core CPI over the last 22 years for a set of top 10 economies. I've got Asian countries being Japan, India, China, and South Korea. And I've got Canada and the US, and I've got European countries as UK, Germany, France, and Italy. So what I want to point out here, this is Canada versus the United States to start. You can see that the yellow line is energy. It's not actually similar. Canada sees much more volatility in energy prices than we do. A part of this is because the chart's being translated through to US dollar terms, and so it's adding in Canadian dollar volatility. But that does lead us to a very important point right now, which is do not misunderstand that the energy volatility in prices is actually coming through and playing a role in a lot of currencies, the Canadian dollar among them. And you can see that the spikiness now in Canada, when you put in the Canadian dollar effects, is very dramatic. So this is one thing you need to understand between Canada and the US. We go over here to Japan and China, those two countries. What I want to point out is the all items less food and energy in Japan, either the all items or the all items less food and energy, basically flat at 1-2%. And as you can look around these 10 charts, Japan really is unique. There is simply no inflation story there to be had. I will point out there used to be some food price inflation there in the 2012 to 2016, 2018 period, but I don't have the data for it coming to the moment. But the energy prices, as you can see, are in fact coming up and down. We add them back in though in Japan. It's only a 20th of the overall rate. It's very, very modest. And you can see the basic story of Japan is there's absolutely no budging. And by the way, there's also absolutely no growth in that country. So China, food and all items. You can see from 2007 on, there's actually been a fairly significant amount of food price inflation in China. The UK, all items and all items less food and energy is actually upward sloping, much like the United States. And you can see that the energy prices are much more stable. That has probably to do with the UK pound story being much more less volatile than the Canadian dollar story. There's just a lot different trading patterns for the UK pound. Down here, Germany and France, energy prices moving around in a different fashion here. But the main point you want to point out is Canada, the US, China, UK, Germany, and France all are showing the same sloping, slowly increasing price inflation. Yeah, it hasn't moved much off too, but it has been moving for a decade or two, slowly and perceptibly. I guess the overall consistency of all these CPI stories is tied to the rising manufacturing real wage in China, and that is being exported around the world in terms of some kind of goods price inflation because everyone is so dependent on that country for their manufactured good, and that is the low-cost supplier, and that is driving up. So this really is reflecting the global rise of China through the price indices around the world. Italy, here again, energy and all items. You can see a pattern that's largely more volatile. Again, that's to be consistent with probably France and Italy, with some differences in how they report it. Over here, we have South Korea. I just want to point out that the food price indices, much like China, did start rising in the period up to the current moment. There was signs of a food price inflation story in Korea. I simply don't know the country story well enough to tell you what's going on there. So that's my background. I want all of us to consider this in context of the energy story. Now I'm going to shift gears and go into oil and gas companies and alternatives. A lot of this is very detailed stuff. I prefer all of you to call Zacks Professional Services after the call and get these slides. A lot of the detail here is simply greater than I have the ability to provide today, so I will move a little faster through these slides. Okay, locations of largest oil and gas fields and those with the highest installed capacity for alternative energy. So here we have oil, here we have natural gas, and over here we have nukes, wind, solar, and hydro. These are your alternatives. Though this is installed capacity, these are the largest oil fields, and this is the largest natural gas fields. So first thing I want to point out, we'll talk Russia for be just clear. Russia has 42 total billion barrels in the overall scheme of things. Obviously, you know about the story of the UAE and the Saudi Arabias. That's only, if you look at the UAE and Saudi, that's 180 versus 40. So Russia has 20% of the oil of those two countries. Interestingly enough, particularly when you think of sanctions, there is actually as much oil in Iran as Saudi Arabia and the UAE combined. So this is a story of likely sanctions that Iran just simply has no ability to extract that oil over the decades of sanctions that have been imposed on that country. That spells trouble for Russia. They're going to see a real decapitation of their ability to extract that oil now that they cannot get parts for all the drilling that they need to do and the refining that they need to do from the rest of the world. So this is an interesting thing to understand. Again, understand that Iran is a bigger story. Over here, now you see something different. Russia has 1, 2, 3, 4, 5, 6, 7, 8 natural gas fields. It is a major supplier of natural gas, and it is much larger a supplier than anyone in the world. They're much larger than us by a huge magnitude. You can see 22400 versus our 2300. And you see that, again, the Iranians in this Middle East are actually very strong with having fields, but probably not developed. Which leads us back to this story. The natural gas coming out of Russia is critical. It's very unlikely that there'll be sanctions on this natural gas. It's simply too big a story to knock out for both sides. But you need to retain understanding of that Russia's oil and Russia's natural gas are very different stories. They have a much stronger position in natural gas vis-a-vis the rest of the world. Okay, over here, I'll skip them, but nuclear, wind, solar, and hydro at a high level are worth discussing. I will only point out that in all three cases here, wind, solar, and hydro, China is the #1 player. And over here in nukes, the United States and France are just a bit above China. But in general, it should be understood that Chinese are actually installing more capacity for alternatives in solar, hydro, and wind than anywhere else in the world. Okay, comparisons of geographic contributions by energy sources. I put the 1973 Arab oil embargo at the top, and at the bottom is 2019 and 20, the current period of time. Again, the order here is going to be crude oil, natural gas, then all of the alternatives. This is the nukes. Those are your hydros. There's your wind. There's your solar. So let's go through it again. Crude, natural gas, the nukes, hydro, wind, and solar. So, point I want to make here. Let's just talk through the oil portfolio. The Middle East is 37% in 1973. The Middle East is now 31% of oil today. Now, over here, we've got a different story. That is, it's a story of how the natural gas market used to be driven by basically OECD countries, and now there's much more play by the rest of the world, including this non-OECD Europe and Eurasia. That is Russia, basically. That's a quarter. And it used to see very much not a player, much less than this, and now it's much bigger. And in the Middle East, about 16% versus 31. Again, a lot of this is coming from the OECD countries, but it's only 40% now. They still need 60% for the world's capacity outside of all this stuff. So again, you can see that basically from here to there in all these charts, there's much more diversification of supply, particularly for natural gas. Over here, I'll let you run through these. You can see, again, the story has become much more complicated and much more diffuse now than it was in the past. That's the big point here. We want to talk about 73, how everything is that big blue circle, which is basically the OECD and the hydro areas and the natural gas, and now everybody else is playing a role, particularly the Asian countries and particularly China, which is this yellow space. They are big players in alternatives. Over here, you can see the Middle Eastern countries have developed their natural gas capacity versus the past, but in fact, the story of the OECD is they're much more dependent than they used to be for natural gas. So keep all this in mind. It's a great reference chart for you to carry forward some real understandings of these issues as we talk about the difference between the 73 oil embargo and today. And that is critical. All right, energy interest groups. I'm going to go through this quickly. All I want to point out is the green shaded ones are the U.S. companies, the blue ones are non-U.S. companies, and the white ones are truly non-U.S. They're basically ADRs. So what happens here is the blue one, there's no ADR issue. The white ones have ADRs. So basically you can buy those. So keep in mind here, we've got a lot of different data. This is the cumulative returns. This is the more recent returns for these areas. And this is all kinds of other supporting data, including the beta, the stock market beta. So go through these names. These are the coal names that we like, know about, the oil and gas names we like and know about. Biofuels, hydro, wind, and geobiomass, and nukes and solar. This is where it gets interesting for you. You might not know these names. So get a hold of these charts and take a look at these names and start to learn them better. It's all worth your time to learn more about the industry groups and the top tickers. Okay, so valuing oil and energy companies. I'm going to go quickly through these slides. I just want to know that you have them and you can get them from us. So here we've got all the different oil and gas companies, and down here you've got all the alternative energy. So a top 10 oil and gas, and then the top 10 alternative energy companies. So there's 20 companies here. And what we're going to look at, and I'm going to go through quickly the 6 or 7 slides, is their CapEx and other types of measures of their metrics. So CapEx, the total assets here, you can see that the oil and gas companies have not been investing the way they used to. And it stops somewhere in the 2014 period. So that tells you something about when the world began to really get concerned about, raising production of oil and gas because of climate change. It's about right here. And you can see the CapEx, the total assets, start to decline for this industry. Down here, you can see that a lot of these companies are IPO specific. You can see a lot of them didn't start until 2008 or 2010 or 2013. This is the story of the building of this capacity. So a lot of people think this is better built than it is. A lot of this is only 10 or 15 years old versus this stuff, which is decades old. But keep this in mind. We're not going to get rid of this period. And we've also lowered its CapEx for 6 or 8 years, which is actually bullish oil prices. So let's go to the next one, reinvestment rate over the last 20 years. Then I've got R&D is percent of sales over 20 years. So reinvestment rate, again, you can have play some time here. Again, top 10 oil and gas, top 10 alternatives. This is very similar to the CapEx story. I don't need to spend a lot of time on it. Here at the R&D is percent of sales, the amount of work that's going into these companies. It is fascinating to get into these stories, particularly down here with the solar and wind and hydro stories. You can see, for example, we've got AENPH, and it's got investment R&D of sales with 20%. Up here with the oil and gas companies, it's 0.1. So the amount of research dollars as percent of sales that are going on down here is in the 20% area. Is basically non-existent out here. So the story of getting a change in the energy composition of the United States, the world, wherever you look, it's all in these standalone companies that are 10 or 15 years old. These companies are simply not doing as much work as relative to their sales. So let's go to the enterprise value to EBITDA over the last 20 years. Again, top 10 oil and gas, top 10 alternatives. I just want to point out energy value to EBITDA, the enterprise value to EBITDA, below 10 are seen as healthy. So as you can see, Sedge and First Solar are above 10, and Exelon, which is a utility company, is below 10 at 7. And you can see up here, Chevron's at 7, ExxonMobil's at 6. So if you're looking across a given industry, you want to make sure that the enterprise value to EBITDA is earnings before income taxes, depreciation, amortization. If this number is below 10, you have a situation that is seen as healthy. Just keep that in mind. That's all we need to talk about here. All right, total debt to EBITDA. Vestas, VWDRY, is a wind company. And I point that out for you that we want to talk about VWDRI. Here you can see that this wind company starts in 2012 with an IPO. It went through a big decline to 2017 in terms of its total debt, and now it's increasing debt and it's over its profits as it continues to build capacity. So VWDRY in the wind story is critical for your understanding. I'm going to point it out here. That's a really interesting one to talk about. A debt to earnings ratio that declines over time indicates a company is either paying down debt or increasing earnings or both. That is a good sign. So again, for the most part, you would like to see these things be going down. And really what happens is they don't do much other than you can see from this current period for the oil and gas players. They really are making a lot of profits, and they really do have a declining story here. So the story of this chart is actually the incredible improvement in balance sheets in oil and gas. The story here is they're still investing. There's really no sign of change other than investors. Okay, times interest earned. This is one I'm going to skip over. This just shows you the number of how many times a company could cover interest charges with its pre-tax earnings. Interesting story to add to the rest of them. We'll skip it for now. Okay, the price earnings multiple. These and the PEG ratio. Okay, price to earnings growth is a key metric. Over here, we've got top 8 oil gas companies. We've got 2 more here, and the top 9 alternative energy companies. This is great stuff for your stock picking once you get to know these names. I think you should spend some time here. It's a great chart for later use. Like I said, I'll give you the story of how to get a hold of these charts later. It's a critical thing for you to look much more closely at ticker names and compare them. That's kind of why we have chart 7 here for this metric. Final one, again, very noisy chart. You need to get this chart here. There's so much to learn here. I just pulled one out for your interest. REGI, ticker REGI, for example, is Renewable Energy Group. This is a biodiesel production company. So they're using basically corn to produce biodiesel in Ames, Iowa. They have 12 biorefineries and a feedstock processing facility. Obviously, taking the feedstock is corn, and the biorefineries are taking it into a biodiesel framework with 12 biodiesel refineries in Ames, Iowa, or around Iowa. So ticker REGI, you probably never heard of it. I had never heard of it. There's plenty of number names here, particularly down in this area. This is the alternative energy names. But we can see REGI has lots of 1s and 2s for the Zacks Rank. Fascinating company. Never heard anything about it. But there's a stock pick for you, just laying there. If you like the renewable story and biodiesels right now, I can guarantee they're making a lot more money than they used to, given the oil and gas story out there. So that is it for me. I've hopefully covered some landscape today that you enjoyed and you can use in your work. And if you want to get a hold of these slides, this is the information you need to take down right now. So first of all, call us at 866-794-6065 or email us at strategycall@zackspro.com. We're on LinkedIn and Twitter. You can see those titles for your interest in finding us. And we do have a webpage, zackspro.com. But again, for these slides, I'll repeat this for all of you one more time. The number to call us to get these slides, 866-794-6065, or email us at strategycall@zackspro.com. Thanks for your time, everybody. I hope you enjoyed this, and I appreciate the chance of speaking with you about important topics. I'll do this again in 2 weeks. In 2 weeks, we'll start the story of housing.